Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for checking in for another episode of Zen and the Art of Real Estate Investing. And this episode, my guest is Jeremy LeMere of Navigator Wealth Fund. We're going to talk about how to use wealth funds to diversify your portfolio. Now, this could be for retirement purposes or just for stretching out your assets across the real estate space. So you're going to hear how Jeremy himself over the years has stayed diversified and why it's important as you grow. Let's go. This is episode 209 of Zen and the Art of Real Estate Investing with my guest, Jeremy LeMere. Jeremy is the co-principal at Navigator Wealth Management, where they direct and offer investment opportunities. And these are client direct fund investments to specific deals. Jeremy started in single-family flips, got into apartment investing, and since 2018, he's been passively investing in out-of-state assets, doing some hard money loans, syndicating in a variety of areas as a means to diversify his own investments. Jeremy, welcome to the show.
Thanks for having me, Jonathan. I'm glad to be here.
Yeah, I've been really interested. I'm doing my back research, and you've really stayed fully diversified since you got into real estate. Tell me how important that is to your overall investment plan.
I think it's really important because it gives me the opportunity to stay in real estate on a broad spectrum, but yet be able to move asset classes when the cap rates kind of adjust in one but not another. There's some arbitrage that happens in that space. And while playing in the backyard still offers us the opportunity to maximize our return on the investment.
Yeah, I completely agree. I mean, I grew up in investing and I've always been kind of diversified. I also like other things like stocks, but real estate's so cool to me because there's so many asset classes and just geographically you can be diversified, right? Is that part of your strategy and just making it very wide? And also it keeps you from getting bored, right?
Yes, it does. There's differences, there's nuances between commercial, self-storage, the multifamily space, and frankly, I've mostly pretty much exclusively exited now my single family and duplex properties, but that's a different clientele in itself, depending on what price point you purchase your assets at. So yeah, it's been a great opportunity to really learn and get a feel for all those different elements and sort out what might be the best time to get in and out and what clientele you really want to work with on a day-to-day basis.
Yeah, that's really important too. And also understanding your strengths. I think a lot of people go from single and multi and they realize, well, it's just hard to scale. The numbers have to be so high to scale and do well in this that then they start looking for larger investments. Is that what happened to you? Because I know you had started to buy apartment buildings and then eventually you decided, well, there's got to be a better way to do this.
Yeah, and mostly the kind of the shift from multifamily into other asset classes was a cap rate situation where there was so much interest, in that migration from single family duplexes over to smaller apartment buildings, even mid-sized apartment buildings, that it really drove the cap rates down. And that adjustment kind of pushed me over into looking at other things. And we had a management component to our operations. And we do that in-house, and we kind of looked at what the complexity was for self-storage, for example, and then even in the commercial space. And the reality was, there's some nuances in how things are handled, but generally maintenance calls are maintenance calls. And as long as we have the systems and processes in place, we can leverage across multiple asset classes. And that's ultimately what we did.
Yeah, and one thing I've been talking to other large scale investors about as well is you're really running a business. So you're running a real estate business, but it's a business on top of the land. And multifamily is a business, of course, when you have a lot of apartments, but self storage is a business as well. There's just different tenancies involved there. And then when you get to retail, it's the same longer leases. Is this what you found that that's part of the diversification too? It's still real estate, but I think newer people to real estate just think, oh, this is just an asset class I'm not going to understand because it's just one thing. Or like financial planners will tell you, oh, don't be too much in real estate. And you're like, but there's so many different opportunities in real estate.
Yeah, I think the important part to recognize is, I'll call it diversification. When I mean diversification, it's not just about across asset classes, it's about across properties.
Yeah.
And it was probably about 10 years ago, I had the opportunity for a small self-storage property along with a single tenant commercial space, which was the primary asset on the property. And at that point in time, it would have been a significantly large portion of my portfolio. And the reality is I passed that up. In hindsight, the pricing was absolutely awesome to get into at that point in time. But the reality was my portfolio wasn't big enough to be able to take that asset. And I always looked at it as, well, anytime I have a turnover, the cost related to this asset is going to be too big for my relatively small portfolio, or, really tied to my duplexes and my single family properties. So I didn't go that route. I'm glad that at the time I didn't, because I still see that as a hindrance in any single asset that we do. That if that thing gets to be too large as a relative percentage of my portfolio, starts to exceed 10%, the cash flow drain that you can incur during that window of time, you either have to maintain substantially higher liquidity capabilities or something in order to tolerate that particular asset when that tenant does turn over. Because it is a commercial tenant-based situation, has longer duration vacancies and a higher cost to prep it for whatever might need to go in there next. So those elements of it, you have to be very conscious of that situation on a particular asset class and keep it in the scale. So when we finally went to commercial real estate assets, we went to like multi-storefront buildings. So they're really in the end, when we bought the building set, there's 10 units in the building.
Yeah.
So we're only turning over even 1/10 any given time when a tenant might leave the property. So those things are really important to think about across the spectrums as you kind of scale up your operations. You can get into those bigger assets, divest the smaller stuff, which ultimately that's what I've been doing more recently.
Yeah, and that's part of the kind of upward scale of real estate. It's the economies of scale. As you were saying, if you have one tenant and they leave, you're at a 0% occupancy. You have 10 tenants, you lose one or even lose two, you're already at 80 or 90% occupancy, so you're hedging better. I really like the way that you describe passing on the deal, even though it was a good deal, because I created this as the mindful approach to real estate investing. And that's like a much more holistic approach to real estate, which is what I think people need. I think there's so much kind of information out there that's encouraging people to get every deal that's good, but it didn't work with your portfolio at the time. And I think that's something that people need to look at now. Look at their overall portfolio. Where is this going to sit with that? Because you were talking about the 10% of cash flow and what could happen in terms of using the money. But there's also a big time element when you take on something new that could take away from the other properties and then diminish their potential returns. Am I right on that?
Yes, absolutely. And I've had situations where that's happened. And I always say that no real estate is worth not sleeping at night, right? No matter how good the deal is, if you can't sleep at night because it consumes you, how you're going to handle some of the issues that may crop up out of it. You found a deal that's too big or too hairy or something that just you have to get past it.
Yeah.
And then move on and then realize what were the mistakes that were there and not make those again. And to your point, the deals can get to be too big, and the troubles, it takes more time to address issues. And as soon as you start having troubles on a really big asset, you start to realize that swell of resource consumption is not just yourself. It's going to take a lot of external folks, and makes it even that much more expensive to handle it from a bandwidth standpoint. Unless you're partnered with a good set of GP folks, general partners, that'll actually help support those challenges.
Yeah, and that's an important point too, because I don't know that everybody realizes what they're signing up, even when they get an 8 unit. You were still working when you got this 28 unit and an 8 unit. Did you soon realize that you basically signed up for a second job? Because that's what I think a lot of people are missing, that it sounds great, but then you do your 9 to 5 and you're doing that. And then your entire weekends and off time is doing service calls or managing the manager on your other job now.
Yeah, precisely. I think that's a key point. I did it with intentional nature of migrating out of my W-2 and making that the replacement and making it flexible time. At the same time, it could have been done with outside management, but that wasn't necessarily the focus on the road that I was heading down. Yeah. But I did switch over and make that my W-2 activity very flexible in when it can be done, generally speaking. And it worked out extremely well for quite a long time. Since then, I've divested that asset, and I actually passed it off in a sale to someone trying to do exactly the same thing as I was doing, because it is that right size asset to be able to do that. 28 units plus a few other units very quickly can be, full-time exit from a fairly high paying job and be able to move into that, manage it. And you can manage extremely well if you've developed the talent on how to manage and do, general maintenance activities. You can manage extremely efficiently, being on site and keeping eyes over all aspects of the operation. It's very similar to having the ideal candidate in your property management business that can do maintenance, management, tenant relations. If you're well versed in that, you can really spread yourself across those different elements and understand the ins and outs. And your tenant base will absolutely love the fact that you're one person. I'd say one person. They know that they can reach out to you and you can address all those issues that are to be had on the site.
Yeah, and one of the cool things about real estate, especially as you get into a little bit larger, when it's single families, generally everyone just wants to take the most money, but you still can get this kind of warmth out of transferring it to an owner who really wants to do it, or where it's a win-win. You get a good price, but they're getting something. But it also goes to the economy of scale that we're talking about. That person who bought it from you had stabilized the asset, so it's running. So even if they're new to 28 units, they're getting something stabilized. They can't really mess it up, barring, a real disaster if they take on, all the companies that you were using. So it's a pretty safe transfer and a way to learn that I think people, again, can do it. It is a lot to take on 28 units, but it's much different to take on 28 stabilized units that have been running and turned over and pay up for it than to take on 28 at 50% occupancy that all need renovation as a first timer.
Yeah, exactly. I agree totally. I think the 28 unit is a situation where you really can, and if you're turning that over to someone like I was able to, you're not in a separated transaction like you would ordinarily be. I transacted it to someone within a local RIA group that I knew well, and that transaction allows them to come back and ask questions, right? And I'm more than happy to help, with them being successful too. So, questions that come up 2, 3, 6 months later, 1 year maintenance type things. It's like, hey, I forgot what you mentioned about this. And you can quick drop a note or whatever. And, because you were doing it, it's super easy to give that information back to them or pull some additional notes out on documentation, from your management system and offer that to them to help them through. It's even very beneficial on their side from tenant base, because oftentimes the tenants, it's kind of like the substitute teacher situation.
Yeah.
And, you get a new owner and the tenants right away are like, well, they shouldn't know about this, right? Because it's the previous owner. But, I would get a text message like, hey, this kind of stuff is going on. What was going on before? And you provide that information and they're like, okay, now we got sound footing for our discussion with the tenant, because they're trying to pull one over on us kind of thing, substitute teacher situation.
Yeah, that's great though, to stay in it and assist. And also it's probably because you did that transaction, that started through a RIA where you already connected. Yeah. But a lot of times when people are selling businesses, they sell them and the old business owner will stay on for 3 years to smooth the transition. So I think that's a really smart piece of advice for others to say, maybe you want to get rid of the asset if you're a mom and pop owner and you're just done. And a lot of people will leave notes, but to be accessible to someone who buys it is so much better, because then that win-win is going to be even better. and maybe they're another buyer or another partner for you down the line as you scaled up your business. I wanted to go back though, because you were, I believe you were an engineer, right?
Yes.
Yeah.
Yep,
So when you were
mechanical.
working regular jobs, and you got out of college and did all that stuff, when was the first time that real estate like kind of got on your radar as something that you thought may play a role later?
Yeah. So, interestingly, when I was a kid in middle school, maybe even, middle school, my parents started buying a couple passive properties, and they were actively managing them. They actually had us at the time, purchase the lawnmower and the weed
Hmm.
eater kind of thing and take care of the lawns. And we were contracted to do that kind of service. So I was first exposed to the real estate, but kind of more on the care and maintenance side at that point. And then I, came out with my engineering degree, went to work in, large corporate world and did that for 20 years. But in that process, two things happened. We finally got to the point where my transitions and relocations stopped. We were going to settle down, and I wasn't going to take any more wasn't planning on any moves, if you will.
Yeah.
And that afforded me the opportunity to then get into real estate so that I could actually be, I'll call it active in it. Because when I first started, I thought I had to be active in it. And number two, that we crossed that point right into the Great Recession. So we were coming into 2008 to 2010. And it was an opportune time to start buying assets because we could clearly see that you could buy assets for way, way, way less than what it was costing to build them.
Yeah.
And at some point, there was going to be a recovery in those asset values. Otherwise, we were never going to build new housing again, right? Which is some of the same battle that we're facing yet today. So, it was really that point that I entered back into real estate, knowing that I was going to be boots on the ground. My travel was a bit less. I used to travel almost 50% of the time to global locations. So, being able to be local afforded me the opportunity to take care of the assets. So that's really when we started getting into it. And then we had to figure out how to start managing financial leverage, in a productive way. And fortunately, after a few years of purchasing just some cash flow, because at that time you could buy almost any asset was over 12% cash on cash return. It was phenomenal. So we were buying assets, running out of capital, and then we started into flipping activities to build capital, and then did some BRRRR activities, and then eventually went exclusively BRRRR, and then started scaling up to multifamily once those assets started appreciating and giving us the opportunity to re-leverage. So we really never had to go back to true flipping anymore after that point, because once you have that snowball going of appreciation, it's just about global cash flow and redeploying asset values and bridging those things together.
Yeah, something interesting I've been talking to a lot of people about now is, BRRRR, when it started and when that even became a moniker, it worked really well because rates were low and prices were great, especially when you were buying. But if you look at BRRRR now, there's people who are reading the BRRRR book and hearing all of us talk about BRRRR, and they're like, I'm going to go BRRRR a property. And we say, well, I don't think you understand how this works. The numbers aren't the same now. They're a little bit better, though, in the Midwest. I still think it's possible. But to try to BRRRR in these major markets is a much different story now than then.
Yeah. I mean, there's a premium on residential properties traditionally. And when there was a significant depression, of those values for an extended period of time, it really gave it a lot of opportunity. And really kind of one insight to know that that's happening is when people end up changing jobs. And this happened in that 2008 to 2010 window. They couldn't sell their house and they were forced to become landlords because they couldn't get rid of the house at the price that they had paid for it. So all they had was the option to rent it to someone and at least cover the payments until either the value appreciated or rents went up and it actually became something of better value. For a long time it was great opportunity, but when you're paying a premium on a residential property or interest rates that are, eating up that cash flow, it makes it a lot harder to do that on that particular asset today. But, we're in a business, we're in typical cycles, at some point it'll come back again and become an opportunity.
Yeah, but that's an interesting corollary to now, though, because it's kind of a different mode now. As there, people couldn't sell because there were no buyers to get it. They needed to rent. Now they could make a windfall on it, but their rate is so good for a single family home buyer. If they're at a 2.75, And even if they need more space, they just don't want to sell because they have to sell. They'll do great on the sale. There's no inventory, but then they have to go buy into a very low inventory market at 6.75. And that's what I think is really, the stopgap in the machine right now in terms of single family.
Yeah. They're almost, from a cash flow standpoint, they lose out giving up the old property. They're better off making it a rental and purchasing their new property where they need to be and doing it for the opposite, to your point, the opposite reason.
Yeah. Anyway, again, though, in the beginning, we were just talking about real estate as a diversified asset class. And this is just when I look at real estate, now we're talking about diversified opportunities in your exit plan. You can't sell when you thought, but you can rent. It may not be your best opportunity, but at least you can. Yeah.
Yes,
I think people get tied up. They're looking at their rent rate and like, I need, $2,000 a month for this or $2,500, and they'll just wait. And it's like, but what if you could just get $2,400? Then you're moving, then the income's coming back in. So it's an asset class that I think you do need to understand, but it's very hard to lose if you hold real estate. Would you agree with me after all these years in real estate yourself?
I agree. In fact, the longer you hold, the better the opportunity is to kind of flatten out the gyrations that happen in the short term in some of the cycle portions. Over time, we may hit the flat right now where we're not appreciating significantly, whether it's, single family or multifamily for that matter. But, the gyration, generally the trend line is up. Historically, it is up.
Yeah. And I mean, I learned that when I was younger. I started playing with stocks at 16, and I would just get hopped up when they would hit their 52-week high. So I would sell. And my dad would say, you might want to hold on. I'm like, I would say, well, I'm setting a record. So if it's at the highest, I'm going to sell. And I look at real estate the same way. Do you have properties over the years that you either wish you would have kept or wish you would have sold early? Because I think that's something that some real estate investors have regret. I think it's just part of the process. But are there any deals or properties that you look at where you think now, could have handled that one differently?
Yeah. And I think, you always could say that if I still held that property, it'd be worth more. Because tends to be always the answer, unless you happen to have something in a neighborhood that you knew was going to be problematic and there was no fix going on for the neighborhood. But generally speaking, I exited quite a few single family homes probably earlier than what I needed to.
Yeah.
But I can't set myself back too far on that because I reinvested those dollars into other real estate that did well anyway. But what I do know is similar to the 52-week high situation is you do want to trim your position, continue to ride it, and just look for something else that's at a different point in that cycle. And you will do well over time as long as you keep that methodology. And I did that most recently. I exited my last 4 single family properties this year. And my last one I exited 2.5, 3 months ago. And the market is now stretching out on days, and the number of price reductions is starting to increase. So when I look at it in general, did I get rid of my entire portfolio right at the peak time? No. Did I get rid of almost everything I had at the right point in time? Probably overall, I did pretty well on that. And so I can't begrudge the outcome of that. But the reality is just, kind of know what the market trends are. And, they're not all the same in across the country. To your point, the Midwest is a little bit different cycle. It hasn't spiked like it did everywhere else. So it continues to notch its way up. Other places are probably going to be a great opportunity here over the next 12 to 24 months to kind of see that flat line, the dip or whatever, kind of flat line and start to come back up, and know that you're in a really good position to probably carry that going forward. It becomes obvious when you start talking about replacement value. And that's the situation we're in now, where building permits are stalling out, and that'll create a shortfall, and then that'll start to create the lift that we need, very similar to what we saw from 2005 up through 2015, kind of the similar type of dynamics happening over time.
Yeah, and a lot of that goes to keeping your head on the market, making sure you know what's going on. Hey, it's Jonathan. I hope you're enjoying this episode with Jeremy LeMere, and we're talking diversification of your assets. And another way that you can diversify your portfolio, thinking for the future, is to talk to my friends at Rent to retirement. I've had Zach Leemaster on the show. I hope you've heard that episode. And you can get extra attention if you go to my link at bit.ly/R2RZen. So that's bit.ly/R2RZen. bit.ly/R2RZen. They're one of the nation's leading provider in turnkey solutions and new build turnkey solutions. Now let's get back to Jeremy and talk more diversification. Geographically, you've been involved in different areas as well, especially as you started to expand to more syndications and things like that. Geographically, How are you making decisions on any type of assets, whether it was single family assets or out of state investing or larger scale opportunities? How are you knowing when this, city is right or the opportunity is right?
Yeah, I think we had a gut feel that something was going on. I'm invested in a property in Austin, and we saw the upswing, and the question was, how long will the updraft last? Things came to a pretty quick halt when interest rates started going up on multiple fronts. Migration patterns changed because it was overlapped with COVID, for obvious reasons, right? That's why we dropped interest rates. But when that migration situation ended and interest rates started to move, Austin is struggling big time from a valuation standpoint.
Yeah.
Anything that was bought in the last 3 to 5 years, depending on exactly where you were in that cycle, you're either doing okay or you're really struggling. But in any case, the supply that's coming online is hurting it overall.
Right.
You really have to be conscious of those things that you can't control. And again, in the end, for me, it's a portion of a portfolio. And it's a stinging lesson of what can happen. And will it come back? Yeah, you'll make your funds back. Is there an opportunity cost to not go somewhere else? Probably. But in the reality of things, you do want to pay attention to kind of how the market is moving in particular segments. The Southeast, I think, is stable yet, but there's some challenges that are yet to be had in that market. And I've got one asset that I'm invested in the Southeast that we'll see, but it is definitely, I'll call it flatline. Rents and occupancies and everything else are all kind of fighting challenges in there, keeping that particular asset from doing really well. That constant notch up that's in the Midwest, that's been the kind of the stable thing that I know, because that's been the territory that I live in and build my portfolio on. And that has been kind of the best situation. So we in the Midwest, generally speaking, have been able to just kind of invest and time will take care of itself. In other places, that's not necessarily the case.
Yeah.
And as a result of that, you really do need to be conscious of what that cycle looks like for those larger markets.
And I mean, Austin's a great example of it's going to be fine long term. Like, it's just, this is happening because of the overbuild and everything that happened at the same time. But again, it's a spot where there are people who kind of need to exit, but they're going to lose a lot. The next person's going to pick up and do really well. But if you can hang on in areas like Austin, or even in places, in the Southeast where insurance is going up, if you just hang on, you're going to be okay. But this is always part of real estate. You're trying to figure out which parts of your portfolio you can hang on. And sometimes you have to take a loss. You still get back the money that you have into it. And you, as you were saying before, you can reposition either a good profit or even a little bit of a loss into something else to offset it, which is part of how we started. That's just keeping your asset classes diversified.
Yeah, and it's not unique to real estate, right? This happens in the manufacturing environment with the gyrations of manufacturing production locations and all those sorts of things. You're going to see some of those similar pains occur in different manufacturing environments as they onshore things or have to transfer to other countries to avoid tariffs and things. So it's just our industry. We have slightly different things that you have to be cognizant of happening.
Yeah. So over your career, what's your favorite asset class to participate in, whether it be as an operator or an investor? Because I know you've been involved in obviously the things that we talked about, single family, multifamily, but also self-storage, commercial retail, hotel to apartment conversions. If you could just choose and the cost was an issue, what's one that you're really enjoying right now?
Well, I actually think it's one of the adjacent categories in the real estate space, and it's I'll call it borderline on the lending side right now.
Yeah.
There's a premium on lending and inserting yourself either from a hard money perspective for the industry that's still, going on relative to fix and flips,
Yeah.
or I'll call it the pref equity or rescue capital that's going on in the space, generating kind of a premium location to insert yourself into in the asset. That, if everything recovers well, the general equity position that was there before hopes to regain ground. But generally speaking, you are looking kind of at the bottom and inserting yourself at a price point that's really an opportune place to make either a pref guaranteed return or be in a really solid position for starting of the ramp up, compared to just inserting yourself into a deal that has all of the risk, last position, I'll call it.
Yeah. Yeah, it's interesting because I think people forget about the lending arm as really it's based on real estate, so it's still really a participant in real estate. And I know a lot of people who, as their portfolios increases, they started lending more because it just made sense, and it's a little bit more hands off if you're judging the assets. So that's something you've been involved with as well, of course, over the years.
Yeah, I did private money lending for a number of years now. I think it's valuable to be partnered with someone who does it on a full-time basis, but there's opportunity to insert yourself kind of into those pools and gain the upside benefits, and stay, depending on if you're doing short-term type lending activities versus long-term in some of the pref equity positions, fairly liquid still, waiting for that kind of that spot of the bottom where you really say, I am going to start to transition out of the lending space and go into more fixed asset long-term holds. That's, you don't have to market time things right to the month or the day, but if you can kind of get in the cycle and start, move your money with the gyrations of it, that's really where the benefits come with some of that pseudo market timing without, the gamble of just doing it all at once.
Yeah. That makes sense. So when did you start Navigator Wealth Management, and what do you guys do there? Because I think that it shows the growth of your portfolio, getting into something like that is then going to be more overseeing what other people do.
Yeah, I personally always had the mantra of helping others invest and make returns when they're too busy or don't have the knowledge base to be able to do that. So, we were syndicating some assets, and then we looked for a more efficient way to address the syndication side. And getting to the fund of funds status has given us that opportunity to kind of streamline the activity and bring all of our investment information and opportunities into one place. So about just over a year ago, we started Navigator Wealth Fund. And that is our kind of foundation to be able to bring opportunities, whether it's hard money lending, whether it's mezzanine debt, whether it's pref equity positions. That's our vehicle to kind of start there, launching those activities out. And also down the road, when things kind of turn to the other position where general syndication comes back to make sense again, we'll go that path through that Navigator Wealth Fund also.
Great. Can you just explain what a fund of fund is? Because that gets tossed around, but I don't think people really understand what it is.
Sure. And we're in a particular segment of it, but we're structured under a 506C offering. So it's accredited investors only at this point. And more specifically, because we want to be operators and function with the assets, because we really believe that having our hands in it to ensure that the financials are sound and that things are happening and we can make the corrective actions necessary, we need to be involved in it. So we've actually structured under what they call the 3C, 5C exemption, where we must be involved with the asset and have decision making. And in doing that, it gives us the opportunity to invest in things like hard money activities where we have an asset-backed situation. We can work on specific investment syndication, buying a particular storage property or apartment complex, as long as we're managing it. And we can continue across the spectrum of different asset classes. We don't necessarily focus on one, but we look at the skill set of being able to understand and analyze the deals and bring those opportunities to folks in a kind of a diverse asset class opportunity way, and be able to get them consistent returns by entering and exiting different things. When I talked earlier about how cap rates compress in one category versus another, it's necessary to shift in order to stabilize and hold that higher level return for your investors. You may have to move around asset classes.
Yeah, and as an operator, having a fund gives you more leeway to invest, like you said, in multiple assets so that you can leverage them against each other's, whereas your traditional one-off syndication, which you still do inside of that, would just be, for me as an LP, I know I'm investing in 126 units, in Topeka or something. And I think that's, what people are starting to understand. But let me know, why is mezzanine debt so popular right now? I keep hearing it, and I don't think anybody knows what it is, but I know it's very popular.
Sure. And there's more than one kind of category of it, but it's a fairly loose term, right?
Yeah.
In our particular case, what we've done with some of our mezzanine debt is actually become the second position. So the bank is in first position on a multifamily property, and we'll insert as a second position lender in that. So it's in front of, it's even better than that, in a more secure position than that pref equity that we talked about earlier. The mezzanine debt, if you can get it secured, it gives you an opportunity to be in on a property that if things went sideways on it, you're still pretty well protected from a valuation standpoint. And it may give you an opportunity or force you, and I'll call it potentially force you into an opportunity to either take over that asset from a foreclosure standpoint, but in any case, financially offers you an opportunity to have a first dibs on an asset that may be appropriate. And yet it still provides, because it's mezzanine debt in second position, it still provides a higher level of return compared to a first position note, and gives the investors, kind of a good balance between the risk and the reward.
Yeah, before you were operating this company, had you invested in syndications or funds on your own as an investor?
I did. As an LP, that's actually how I initially got an understanding and I'll call it a general expectation of what syndication was.
Yeah.
Kind of learn from the outside before necessarily tackling it from the inside. My goal always in what I do is always to try to meet and beat, whatever's around me. I have this philosophy that's you don't necessarily have to be the best, right? One person's going to be the best at anything there is, but this real estate thing is so large and so wide across the country. I view it as long if you're in the upper third from a performance standpoint, similar to the stock market, if you're in that upper third, you're doing pretty darn good. Just if you can keep yourself in that upper third, you'll do really well. The middle third, you'll do well, generally speaking. The folks that get called out of the system are generally going to be in the lower third. They get caught up in market situations and things like that. So just make sure that you're in the upper third. You got protection of the middle third, and you should perform extremely well over a long period of time.
Yeah, and the time in the game really is part of that computation too, because I always think of it just like these kind of like short-term rental reviews or just reviews of a restaurant. If you have 100 reviews, a 1-star is not going to hurt you that much. But if you have 7 reviews, that 1-star is going to crush you and actually will make the algorithm, or in our example, the people looking to invest, less likely to interact, even though the scale is smaller. So it is so important to keep being much, much better to be consistent at an 80 than 100, 0, 120, because that will affect your performance over the time frame as well.
Yeah. Agree. And we build very tight relationships with our investors. I mean, it is syndication. I think the updraft that we had for, better part of 5 to 7 years is just now getting reconciled with the last year and a half of understanding that, you have to know what's going on, and been a little bit cautious when interest rates were so low at what's going to happen. How can all other forces just go so favorably without the rest of the elements catching up in some way? To your point, property tax, valuations went up, but taxes hadn't moved. Well, taxes are moving now because the municipalities are catching them up. Yeah. So the reality is everything's starting to kind of equalize back to where they were 7-8 years ago from a balance of cost across expenses. But if you weren't in a position to be able to handle that coming back, it's very detrimental. It'll take another 3 to 5 years to kind of level set at a new price point that's going to even get the equity back whole again. It's seriously challenging. I get it for some folks that are dealing with that.
Yeah, and that's another long-term, short-term thing. I think if you look at the 25-year performance of almost anything as it relates to real estate, it'll be pretty much similar, steady. Technology has some advancements. But of course, when you look in this kind of micro position through, a microscope, it can look different because if you just look at what happened, everybody said, oh, well, if rates go up, then single family prices are going to go down. It's going to be no problem. And of course, that's not what happened. Rates went up and values went up. So
Yep.
it wasn't something expected. But if we look at the 25-year cycle, I think it'll, generally look regular.
Yeah. Yeah. And it may be a little bit slower on the uptick now. It may not be, right? We may have had a one-time inflationary situation that will never get leveled back out. We'll go back to normal types of things. Or we stay on a higher course of inflation over time. I don't know exactly how it's going to happen, but I do recognize that there's arbitrage in some of the timing events that happen, and there were a lot of cities and municipalities that didn't catch on to the fact that they weren't increasing real estate at the pace that it was going up. They thought, oh, we're in a slow climbing market; it shouldn't be jumping like that. And in some cases, they went through and did the valuations and property taxes went up significantly. And because it's in the multifamily space, it's a little bit detrimental to actually start raising the property taxes significantly on those assets because the landlords have very little option to handle that except for to pass that cost on to the tenants. So, they're going to send a letter out to the tenant saying, hey, our property taxes went from X to 2X. And we're passing that on. So your rent's got to go up significantly. Yeah. Those folks are going to see that in reality, at least a fraction of them. And that's not politically favorable. So, in some cases, the municipalities have had to stretch out the increases over a number of years to marginalize that rent increase to the tenant base so it doesn't become problems for both the landlord as well as the tenant. But those real realities are there. And in other places, it just jumped. Right. Yeah. And they bit the property owner or the syndication that may have held it, and they're reeling from that situation in a cash burn kind of world. And, every municipality and every market is kind of behaves a little bit different, but the outcome is the same. Values went up.
Yeah.
The impacts of the costs went up, and we got to restabilize at those new points.
Yeah, and there's a dual hit for a lot of people that are in the areas where insurance has gone up, 50, 60%. Yeah. They're getting hit taxes and insurance at the same time. And that's what's capsizing a lot of those deals, especially if they're on bridge debt or something. There's just no way to recover. It's just not possible.
Yeah, and appreciation forces insurance to go up too. I mean, the reality is replacement cost is higher.
Right.
Yeah. If contractors are charging more, your insurance is paying for the replacement. It's not paying for the asset that you have now. It's paying for the fact that it's going to have to rebuild. And it won't take long for them to figure out that their reserves need to change.
Yeah, and that's actually a really important point on the smaller scale. Larger scale, they're going to protect your replacement costs. They're going to demand it basically. But on, single families, you could have a very nominal replacement cost right now that isn't realistic on your insurance policy and not understand it. You may have a replacement cost of $400, but it could cost $600 to rebuild what you want now.
Yep. Yeah. And in some cases, the reality was you only have that small dollar amount invested in it, and it's your choice.
Right.
As long as your loan value isn't significant, you can make the choice that as long as I get my money out of the asset, I'll just cease the asset, right?
Yeah.
You could sell a vacant lot if it were to burn down or something like that. So, you may be whole, but the reality is you can't afford to rebuild with what you might be insured at. So yeah it's very true.
Yeah, and some cash buyers may make the decision in some of these markets to go uninsured if they have enough and just say, well, that's just the cost of doing business. I'll just have to rebuild or repair every X amount of years.
Yeah. I don't recommend that starting out, but once big corporations self-insure. There's a reality to a certain point at which you can choose to either have much higher deductibles and things like that, but definitely be in the right position to do that.
Yeah, I'm not recommending that either. Before we hop off, I wanted to just touch on something that I found interesting in your bio. You're still very active, and you talked about doing that deal through a RIA. How important was it through the years for you to be involved in RIAs, local apartment associations, and other other real estate investing meetups in terms of growing your sphere, learning things from others, and building partnerships. Because I personally believe it's the most important thing for new, seasoned, and experienced investors is to find that tribe, whether it be helping others or getting help from others. How's that played a role in your career?
I think the most important or the largest impact it's had on myself has been the reality that you can do that activity. So my parents had duplexes, right? A couple duplexes, maybe 3-4 duplexes, and then you're capped out. Well, the reality is there is a way to do more, to have more units and things like that. But without knowing someone or talking to someone on how it's accomplished, it's not something you're going to go to school for.
Yeah.
There's no degree, there's real estate degrees, but it's much larger commercial related things. It's, institutional level type of knowledge. But how do you get yourself to go from single family duplexes, just getting your hands, into it, up in size? And, I had limiting belief that apartment buildings were not in my wheelhouse.
Yeah.
Well, the reality was I didn't even do a 4-unit, and I should have done a 4-unit because I would have realized that 4-unit was better than having 2 duplexes in a sense.
Yeah.
But the reality, jumping to 28-unit was scary at the time. But I had mentorship and things going on, and I was able to talk to other individuals in the RIAs to understand the local market and understand, some of the smaller multifamily things. And that really got me over that limiting belief, which then, catapulted me into the syndication space and going out beyond my local market, just my local RIA, and getting to that next level of knowledge and coaching with groups that are thinking even bigger and putting yourself in rooms and masterminds that enable you to really facilitate much bigger things and address, some of the challenges with larger operations.
Yeah, I completely agree with all of that. And I've watched it happen in practice. I think it's actually amazing to see because it's just so clear that it's the one place where you can see someone who looks like you. And of course, not like twins, more like Danny DeVito, Arnold Schwarzenegger twins. But you just realize, wow, wait, they're doing it. Like you said, it can immediately destroy the limiting beliefs to just know, like, these 3 people here have done this deal that I'm trying to do, and they're just regular like me. There's nothing special. They didn't pull up in a $200,000 car. They're just doing their thing. And I found that to be such the one thing that can take people from all that knowledge you can get in books and all that people can learn listening to us on podcasts. Still, you need to connect with someone in real life. So you just know that it's really possible.
Yeah, it's amazing. We've had unusually high appreciation over the last 5 to 7 years. But I have watched a tremendous number, dozens in my very small market of individuals that had started with between 50 and 100,000, were heavy kind of early on in the BRRRR stuff, and they've even moved out of BRRRR straight to acquisitions and created millions of dollars of wealth in 5 years.
Yeah.
It's been a phenomenal ride the last few years. Now it's a matter of, did you learn the tactical items to stabilize your assets and maintain activities? And if you got a broader business acumen and you've kind of refined yourself across more of the necessary skill sets, you're certainly going to stabilize and make it through this challenging window from a rising expense standpoint and kind of rent freezes and things. But when you come out of this, you've honed all of the skills necessary for the entire market cycle, and you get to do it again if you're young enough, to do it 1, 2, 3, 4 more times in your career. Some of these folks that I worked with in the RIA, they were 25 years old 5 years ago. They're hitting 30. They don't even have a W-2 job anymore because real estate is their space. They still have another 30 years to multiply this several more business cycles with great opportunity to do great things. At the same time, I know a good number of folks in different circles that I work with from a mentorship standpoint. They don't want to be huge. They just wanted the time freedom, and they're already there. And now they just get to kind of maintain a hobby in a sense, because they've got it to scale, and they just need to kind of continue to grow it, and then eventually pass on that potential wealth to their children or whatever family that they want to leave behind, or whatever organization they want to leave it to. So tremendous opportunities with time, as you mentioned earlier.
Yeah, and stabilization, I think, is a really important word because the way that I look at it, if you're getting up to 4 or 5 properties, one of them's probably not great. So if you can focus on stabilizing assets instead of trying to get into this doors commodity where you just want more and more and more, you're just hiring on more issues. You have buy a 4 unit, then a 5 unit, then a 6 unit. Well, now what happens when repairs are due on all of them? I think people are forgetting about that. And I really like the word stabilization because as I hear people, I always ask, well, how's your first property performing? Is there a lot of CapEx coming? If you know that you have to replace a roof and a furnace, this isn't a good time to buy a new property because what happens when they need a furnace also? And you can do that. That's especially important the larger scale you go, right?
Yeah. Yeah. And yes, I agree. And I think that, managing the CapEx piece and the amount of interaction that happens by having older assets and things like that, in some cases, you may be very well better off investing the cash flow, especially at times like now, where labor costs are getting more favorable for maintenance activities. You kind of want to spend some of that money into those things up front while we're at kind of this opportune time where labor is available again. And you can get these supplies and materials at a good price point again. Take care of some of those things, stabilize it, because I did a lot of that and rejuvenating some assets that I had bought that were pretty depleted. I did it just as COVID started to come into play. Mm-hmm. And, back then the cost of flooring is half of what it is today, along with all of the labor structure that it took to do many, many rehabs that I was doing at that time. And poof. The appreciation and the value of having that new, that rejuvenated property was much more significant when the valuation of those materials and labor and everything occurred over the last 2-3 years.
Yeah. Excellent. I really enjoyed this conversation. Where the best place to get in touch with you, would that be at navwf.com, which is for Navigator Wealth Fund? That's navwf.com.
Yep, that certainly can reach out to me there. We have contact information there, or you can reach out to me at jeremy@lemere.com, first name at last name.com.
Okay, awesome. Jeremy, it's been an absolute pleasure. Glad to get you on the show, and I look forward to staying in touch.
Thanks, Jonathan. Great being with you.
Yeah, appreciate it. That was Jeremy LeMere of Navigator Wealth Fund. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on the next episode of Zen and the Art of Real Estate Investing. And next episode, my guest is Marcia Sokas. Now you're going to hear investing, renovating, DIY fun, and how Marcia's journey is so interesting. She did this all on her own, figured out flipping, investing, involved her family. It's a great story, and I can't wait for you to hear. So we'll see you next episode.